Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to talk about property ownership, particularly property ownership in personal names. And it's actually thanks to a question that I received on YouTube. Doing more videos over on YouTube, so if you want to check out the Investopoly YouTube channel, that would be great. In fact, we're going to run a live event at 7 p.m. on the 28th of May, and I'm going to interview Jared McCabe, and he's going to talk about the top mistakes that people make when buying property. We talk about in this podcast a lot about asset selection, that is choosing the right property in the right location to hold for the longer term and benefit from compounding capital growth. So I'm going to interview him to really nail that point home over on YouTube. Anyway, more to follow about that, including, I imagine, a registration link and so forth. But that's on the 28th of May at 7 o'clock over on YouTube. Anyway, let's get back to today's episode, which is really about property ownership. So previously in this podcast, I've explained that I tend to not own property in a family trust due to higher land tax and the likelihood of the negative gearing being trapped inside that entity. But last month, I spoke about potentially owning property in a investment company. That was episode 350, so if you're interested in that, check that one out. But today what I'd like to talk about is actually owning property in personal names, which that's what most property investors do, is own property in personal names. And so let's start with your options, because it's important to understand the three different options that you can own property. Now, of course, if you are buying property with another person, or you potentially could buy property with another person, the first option is joint ownership. It's probably the most common type of ownership, particularly with houses, primary places of residence. Most people own their property jointly. All parties are on title, but there's no discernible ownership percentage. It's just assumed with joint ownership that each person has a equal ownership of the property. The next option is sole ownership, obviously, and that's very self-explanatory. And the final option, again, if you could potentially co-own a property with another person or people, is what's called tenants-in-common. And that structure differs a bit to joint ownership because tenants-in-common allows you to ascribe a particular ownership percentage to each person. So, for example, one person could own 1% of the property and the other spouse could own 99%, for instance. So now what I'd like to do is talk about the main benefits of each of these individual ownership structures and when we might use them, and share some perhaps creative planning opportunities that you might not have considered in the past, and things that we will take into account or consider when advising clients around property ownership. Okay, the first one, let's talk about sole ownership. Now, of course, if you aren't co-investing with someone else, well, then, of course, that's your only option if you're going to own it in personal names. But, of course, let's focus on the common situation where we're working with clients and they have a partner or spouse. Sometimes putting the property 100% in one person's name makes sense. And the things that we would think about here, firstly, negative gearing. Negative gearing and maximising negative gearing has a large impact on the internal rate of return of an investment, because obviously maximizing tax benefits essentially minimizes the after-tax cash flow cost of holding onto a property, which means the least money you put into the asset, holding the capital growth constant, the higher the percentage return. And I've spoken about this a couple of times in this podcast, that really successful investing is about two different sort of steps or two different focuses. Before you buy the asset, it's all about capital growth, selecting an asset that's going to give you the highest growth rate on average over multi-decade periods. And then the second, once you've done that, you've bought that asset, you've locked in your capital growth, because that's typically dictated by the location and land value and land size and land orientation, all these sorts of things. And so once you've locked that in after purchase, then you focus on cash flow. And that's why maximizing negative gearing can be really important. And so for someone in a significantly higher tax bracket, so earning, taxable income of more than 190,000, means that they will enjoy a 47% tax rate benefit on any negative gearing, essentially almost halving holding costs of a particular property. The other thing we will think about with respect to sole ownership is land tax. See, each individual has a land tax threshold. And when you have joint ownership, sometimes you lose that individual in different states. You lose that individual land tax threshold, and you are then taxed on your joint ownership, if you like. So, for instance, in New South Wales, each person can own up to just shy of $1.1 million of land before being subject to land tax. So obviously that's a pretty high land tax threshold. It's pretty attractive. That means each spouse can individually own about $1.1 million of land, almost $2.2 million of land in total, and not pay any land tax. However, if that property was owned jointly, because they would be taxed as kind of one owner, one joint owner, their land tax liability on around about $2.2 million of land would be over $17,000 a year. So in that instance, if we're going to own $2.2 million of land in New South Wales, and that's spread across two properties, we'd actually be better off if each spouse owned one property each, because then they would avoid land tax. So that's just a little idiosyncrasy with some states where it's important to try and benefit from the individual land tax threshold, particularly in states where that threshold is very generous, like in New South Wales, and Queensland's pretty generous as well. Okay, so that's sole ownership. Let's talk about the main benefits of joint ownership then. And remember, this is the most common way people own their family home. So one of the biggest estate planning benefits of joint ownership is that if one of the joint owners dies, the ownership of the property automatically reverts to any remaining surviving joint owners. So, for example, if two spouses own a property, one of those spouses passes away, the property automatically transfers into the surviving spouse's name. It doesn't actually get into the estate, it misses the estate. So for anyone that might have some concerns about their estate being challenged, joint ownership can be a really good solution for them because it avoids that property, that asset forming part of that person's estate. The other advantage of joint ownership is obviously spreading the capital gains tax liability. So obviously this is down the track if you decide to sell the asset. If the asset is owned solely by one person, obviously they wear 100% of the capital gain. Whereas if you have more than one owner, then obviously you can spread the burden of that capital gains tax liability across many taxpayers, thereby potentially minimising the amount of tax that you have to pay. Now, the saving reduces depending on the gain, just as a percentage terms. So if you're able to spread, a gain across two taxpayers, essentially the benefit is that because income tax is taxed marginally, so the first 20,000 no tax, the 20,000 to 45,000 attracts 18% of tax. 45,000 to 135,000, 32% of tax, and so on and so forth. So by utilising, distributing at least 90,000 of the net discounted capital gain to an additional individual, you're going to take advantage of those marginal tax rates. And that's going to save you about $34,000. So if I have a really large capital gain and I can distribute it to another person, for each individual person I add, I'm going to save $34,000. Now, if you make a huge capital gain and you've got to pay $500,000 in capital gains tax, percentage terms, it's a saving and no one's going to balk it. I mean, I'd rather $34,000 in my pocket than the ATO's, but it's not going to move the dial that much. So whilst we like to think about capital gains tax, we don't want to be too focused on it, because it's very likely that negative gearing will be worth more than a potential, and I underline potential, tax saving, 10, 20, 30, 40 years from today. Again, if we're only saving, if you've got a capital gain of several millions of dollars, I've done the calcs, you'll save somewhere between 1 to 3% of your total tax bill. So there are some tax savings there, but let's not be too focused on them because it's really negative gearing is most likely, depending on the scenario, but most situations is going to be much more valuable than a capital gains tax savings. If I revert back then to sole ownership, what I'm essentially saying is one of the downsides of sole ownership is one person's going to get the capital gain, but if that allows us to maximize the negative gearing, actually in the long run when we spreadsheet it, particularly because I benefit from negative gearing today, whereas I've got to wait many potentially years or decades to save on capital gains tax, I'm going to be miles in front by probably sole ownership if it maximizes that negative gearing benefit. Okay, and it's tenants in common now. Let's talk about tenants in common, which is the third option that I spoke about at the beginning of this episode. There's really three benefits that a tenants in common structure, or three applications perhaps is a better way to say it, that we would consider it. So firstly, tenants in common is different to joint ownership in that the share of ownership moves into the person's estate. So if we're co-investing with people outside of our family unit, that could be siblings, it could be friends, it could be other family members, for instance. We typically would want to hold the property or own the property as tenants in common so that if we pass away, my share of that property moves inside my estate and doesn't automatically transfer to the surviving joint owner. So that's the first application we'd use tenants in common. The next one is really from an asset protection perspective. So probably statistically, the biggest asset protection risk that most people will be subjected to is a relationship breakdown, whether that's de facto or married relationship. If it doesn't work out, of course, there needs to be some sort of financial agreement reached where assets need to be split. And so that's probably, other than being sued by a creditor or something like that, which is pretty unlikely in most people's situation, really when we look at it, it's relationship breakdown that's probably the biggest material asset protection risk. So in that regard, when we're advising a couple, when the couple is our client, both individuals, what we will typically do is we will typically structure the property ownership to maximize negative gearing benefits, but we would also have some consideration to that potential asset protection risk. And so in that situation, what we might do is own a property tenants in common with the highest income earner owning 99% of the property and the other spouse owning 1% of the property. Now, if they own 1% of the property, it means that they're entitled to 1% of the income, 1% of the capital gains, all those sorts of things. Not the reason we're doing it for. The point is that if both people are on title, it means that one person cannot unilaterally deal with that property without the authorization of the other party. And so because, both spouses are our clients, what we really need to think about in that situation is, should the relationship break down, we want to make sure that everyone's share of the assets is protected until they actually reach a formal financial agreement that's approved by the courts through a separation. Whereas if you have only one person on title, they can go and see the real estate agent, they can sign a sales agreement with that real estate agent, put that property on the market and make whatever decisions in terms of pricing decisions or sale decisions with that property without any need to necessarily go back to, their former spouse or ex at that particular time for any authorization or any involvement like that. Now, we've had situations where that's actually been a positive. So where we've had a client, they've always just been our client. They might have a spouse, but the spouse is not our client. In that situation, we might like our client to have sole ownership of property and therefore sole control. But where we've got a situation where we're looking after both parties, a tenants in common structure is good for that. And really, people need to, whilst not every spouse is necessarily going to be as involved in the financial decision making, we think it's really important that each spouse has a good understanding and that it makes sure their assets and their share of wealth is protected. And a tenants in common structure can be good for that. And the final situation where we might consider using a tenants in common structure is where we have cash savings or expect to accumulate cash savings and material amounts of cash savings over the next sort of period of time, let's say next 10 years. What we might do is use a tenants-in-common structure to alter the gearing ratios between the two individuals in the family unit. It's probably best if I explain this using an example. So let's say that we've got a client, they're going to go and buy a $1 million investment property. Let's ignore costs and stamp duties and so forth. Let's keep the numbers round just for the sake of ease. So we're going to go and buy a $1 million investment property and they've got $300,000 of cash. Now, we don't want them to contribute the cash towards the property because we know that the loan amount that we establish when we first acquire a property is the maximum we'll ever get against that asset. You can never really re-gear again unless you change the ownership, but that triggers stamp duty, so you wouldn't do that. So in that situation, if we had a situation where one spouse was earning all the income, the other spouse had no taxable income and $300,000 of savings, what we would do is we would put 30% or maybe even 40% of the property in the non-income earning spouse's name, and then we would put the remaining share in the income earning spouse's name. And so again, keeping the math simple, let's say we put 30% in the low income or non-income earning spouse's name. What we would do is we'd go and borrow $300,000, set it up as an interest-only loan, attach an offset account, and put the cash savings in that loan. So whilst that spouse owns 30% of the property and will get 30% of the income, they have no interest deduction because they're using the cash to offset. And because they've got no other taxable income, they're not going to pay any tax on that 30% share of income. Whereas the higher income earning spouse owns 70% of the property, so they'll get 70% of the income, but really 100% of the family's interest deduction because the net loan's only $700,000 or $700,000 to acquire their 70% share. And so what we're doing is moving some income into the low income earner's spouse's name, and really the higher income therefore has 100% of the negative gearing benefit associated with that property. Now you could actually be a little bit more tricky. You could put like 40% into the lower income earning spouse's name and have like a little bit of an interest deduction there, but still it's positive cash flow, particularly if you expect to continue to save or build savings in an offset account. Now, over time, you might even redistribute some of that cash in offset. You know, for example, if the primary income earner was to retire, they're not necessarily going to enjoy the negative gearing benefit anymore. So in that situation, what we could do is move, some of that offset monies more evenly across the debt. Maybe 200 in one and 100 in the low income earner's spouse's name. But the benefit of having tenants in common is you can ascribe different ownership percentages. You can then set up loans solely to acquire that person's percent of the property, attach offset accounts, and then just move the monies between the offset over time to change the individual's gearing rate. And if their tax position changes, you can kind of accommodate that and optimize taxation outcomes at a family group level by moving those, individual attributes around. So, of course, this discussion today is really focused on property investments. What about the family home? How do we own that? Does that really matter? Well, obviously the family home doesn't attract any negative gearing or any capital gains tax. So, usually the decision around ownership is a lot simpler there. I guess there's only sort of two considerations where, you might potentially take a different approach. I think if one spouse has, the risk of a lot of personal liability, you might not put the home in their name. I can't really think of a necessary great example of that, but, occupational health and safety can be held personally liable for, but typically, really to be held personally liable for, any business related matters, you've got to be criminally negligent for that to occur. Normally, insurance cover is quite deep. But, if you somehow believe that that person's at risk, maybe a tenants-in-common 99-1 structure might accommodate that risk. The other consideration is where the home could eventually become an investment property, and that would be probably most common for first home buyers. Typically the first property you buy isn't your forever property, and it can be just a stepping stone to get into the property market and might eventually become an investment property. So you might then think about, how do you maximize potential gearing and negative gearing benefits and capital gains tax benefits. So hopefully this episode, it's a really long-winded answer, I guess, to one very simple question on YouTube, but hopefully it gives people a bit of sense of, some of the things that we think about in our business when advising clients on property ownership. I guess, there's no one ownership structure that sort of perfectly suits all current and future outcomes. And you do have to, think about what could change in the future. I think that's one of the benefits of getting advice is that we see many situations and, that everyone's situation is different, but there are commonalities. So, when we talk to a client, we start to think, okay, we've seen this before. This is what could potentially happen. And it's not something that you might necessarily foresee because, this is your first time of living and first time of going through this, life stage where we've seen it sort of many times before. But you've got to try and balance out, what's going to be the best for the next shorter period of time, but how will it sort of play out in the longer run as well? And we only get one go at it. So you want to be really careful with it because typically changing a property's ownership down the track is cost prohibitive. It will trigger stamp duty and also capital gains tax in almost every situation. And so that cost just becomes too much to warrant changing it. So you want to make sure you make that decision perfectly at the beginning. Okay, so let's get into some listener questions now. And the first one's a bit of a long question from Pierre. Not his real name, just wants to use an alias, which is completely fine, of course. I'm going to paraphrase because Pierre gives me a lot of information. I appreciate that because more information, the better. And of course, this is not advice, it's information only. But Pierre's given me a bit of a rundown of his situation and asked me what he should do in his situation. And that's what I'm going to talk about. So Pierre's base salary income, 170, his wife 43. Pierre also gets some bonus and about $30,000 and as well as some annual shareholdings, works for a US company. So benefits from some annual dividends and shareholdings and so forth. So total family income is around about $250,000. As I said, they own some shares. Pierre owns about $350,000 of US shares in his employer, and his wife owns about $25,000 in AFIC, which is the ticker code for Australian Foundation Investment Company. It's a listed investment company, actively managed fund. I'm going to come back to it. They have super, of course, about $250 for him and about $135 for her. So almost $400,000 of combined super. I should say that they're in their late 30s with two kids, aged 3 and 5. In terms of their home, relatively investment grade, so ticks a lot of boxes in a slightly busy location. But, there's always, with every property, there's no such thing as a perfect property. And you're going to have positive attributes and negative attributes as long as the positive attributes more than outweigh the negatives. I mean, there's some negatives that just you shouldn't put up with. So I think on balance, I would say his property is pretty close to investment grade, worth about $2.2 million. They've got a mortgage of $620,000 with about $170,000 in the offset account. So what are we dealing with? About $450,000 of net non-tax deductible equity. So they've got a lot of equity in the family home. And in terms of surplus cash flow, about $35,000 to $40,000 a year. And they're wondering kind of what their next step is. So, young children, established family home, relatively conservative debt levels, relatively healthy super balances as well. But a couple of moving parts in terms of the employee shares with the US employer. And then, what's the next step? What's the best way to allocate surplus cash flow? So they've worked out, in fact, working with our firm, they've worked out that their borrowing capacity is about $950,000. So let's say 900 to $1 million in terms of that sort of scope. I'm sure they could massage the borrowing capacity a little bit. So what would the next step be? Well, because they're late 30s, still got quite a long runway to retirement, more than a couple of decades. If we aim at, say, 60 for retirement, there's no doubt in my mind that they need to benefit from some compounding capital growth. They're obviously off to a good start with their home, and that's enjoyed a lot of capital growth, which is great, but it's a personal use asset, so it's not going to necessarily fund retirement, although it's a great sort of plan B. So what they need to do is really build their investment assets. The easiest way to build investment assets is benefit from compounding capital growth. As I said, you get 7% on average over a very long period of time. Your asset value doubles every 10 years, really does all the heavy lifting in terms of accumulating wealth. So really between now and say age 60, if they buy something for, let's just use round numbers, $1 million, hopefully it's worth $4 million by the time they get to 60. It's a pretty, I'm going to say, easy way to accumulate another $3 million of investment assets, pre-tax of course, pre-CGT, but a lot of wealth between now and then. So there's no doubt they should do that. I would buy a villa unit. So Pierre talked about, I've spoken about investment grade apartments, and they probably don't have the budget yet for a house, but I would buy a villa unit or possibly a house. You might be able to squeeze into a house if you're lucky, but probably a villa unit. I think it's a good in between, a house and an apartment. Obviously a villa unit, typically a single level dwelling that sits on its own land, and you might get 3 or 4 on a block with, a driveway that goes down the centre or go down the side of the block. But it's like a small house really, and I think they'll become more and more attractive, particularly for downsizers that want to stay in the location that they're in. And so I would put all that borrowing capacity towards that, Pierre, and that would be certainly my next step. And then Pierre's asked, what would I do with my cash flow? So what I would actually do is encourage someone in this position to make friends with having a home loan for a lot longer than they otherwise would need to have. So because they've got $450,000 of debt relative to their income, $250,000 gross family income, it's a pretty small amount of debt, and they've got 20 years, until retirement. So they're well and truly going to repay the mortgage, even if they don't make too many extra repayments. So the way I would look at this, I would say the mortgage is probably one of the lowest priorities. Repaying the home loan mortgage, one of the lowest priorities. I would put all your resources in cash flow towards acquiring more and more growth assets, because that's really the strategy here, is trying to build your asset base, your investment asset base, because at the moment you've got the shares, which are great, and then the super. So you're off to a good start, but it's really about sort of compounding that amount. He's asked, what should I do with my shares? So AFIC, which is that listed investment company I spoke about, it's been around for a long time. Probably one of the first listed investment companies that were available on the ASX, but it's underperformed. It's underperformed for a long time. It's always underperformed, really. So even on its website, if you have a look at it, the ASX 200 index has produced a return of 8.6% over the last 10 years. And AFIC has produced a return of 7.2%. So more than 1.4% sort of underperformance there, which is kind of surprising really, because the Australian market is small, and I would argue that it should be relatively easy to outperform the Australian market, even though the evidence doesn't show it. I think it should, because you just form a view on the banks and the miners, and maybe a couple of ones like CSL and Wesfarmers and Telstra, and if you can form a view on them, and which wouldn't be that difficult, I wouldn't have thought, surely you can outperform the index. Anyway, it hasn't happened. So I would say get rid of them, sell them, and just put it in the home loan. So reduce your home loan debt. Obviously, the strategy here would be to try and reduce your home loan debt to maximize your borrowing capacity on the other side. So if you can, try and get yourself to that kind of $1 million, or even just slightly over that $1 million budget for an investment property, I think that would be really worthwhile. In regards to the employee shares, I've spoken about this before in the podcast. Our strategy typically is, we're already earning income from a particular employer and a particular industry. We don't want our wealth to be tied to that employer and industry as well. And so our view is that we would strategically and progressively divest of employee shares. So if you took the view that you thought they were wildly undervalued, then okay, maybe you would divest, to a lesser extent. If you thought that they were fully priced or even overvalued, then you'd be more aggressive. So for example, if we expect our client to receive, let's say $100,000 on average in shares, we would say, let's sell $25,000 per quarter. At some point over the quarter, I'm going to sell $25,000. I can be a bit strategic in terms of timing. Whether I get that timing right or not, it's probably neither here nor there. It's not going to really move the dial very much, but at least I'm progressively exiting that investment and doing over time. if I get to a point where the share price is, so depressed that I think it's ridiculous value, I'm selling them too cheaply, then maybe I dial down and only sell $10,000 this quarter. Whereas if the share price starts to run away a bit, maybe I'll sell $50,000 this quarter. But essentially what we want to try and do in most situations is hold a small float of shares, but we don't want too much of our wealth tied up. And so if we go back, we can see that Pierre owns about $350,000 in these employee shares. The opportunity cost here is that, sure, he could sell them and he might have to pay some capital gains tax and whatever, but the opportunity here is that he could dramatically reduce his home loan and therefore increase his borrowing capacity, and maybe to the point where now he is in a house territory. And so what would you rather do? Hang on to these shares and then compromise on this purchase, going into a villa unit? Or would you like to sell the shares and then go all in terms of getting a really good quality asset and holding that asset for the next 20 years? Well, if I was in Pierre's situation and if Pierre was our client, I think we would be, and I don't know the company that he works for, by the way, so I haven't formed a view on the stock. I would need to do that. But putting aside or, assuming that I don't believe that it's wildly undervalued, then I think I would progressively divest, maximize my borrowing capacity, go and buy an investment property. And then with any surplus cash flow, I think I'd be making additional super contributions or even building a share portfolio, maybe in the wife's name because she's the lower income earner, but maybe not with AFIC or anything like that, using more evidence-based ETFs to do that. And just finally, Pierre's asked a question around, should I continue to buy shares in the company? So you can buy shares in the company at a discount. So almost always we would say yes to that situation. If there's a little bit of kind of free capital gain there where I can buy shares at a discount and I'm pretty comfortable with the shares don't have too much volatility. Like, I don't necessarily need to sell them tomorrow, but if I hang on to them for the next couple of years, I'll find a time to sell and exit that position at a profit. Then I would definitely keep doing that. The point is that we don't necessarily want to hold zero shares in that company, but we don't want to continue to hold a lot more of our wealth in that company because, we're going to become very single point sensitive. There's going to create too much of a concentration risk from a wealth perspective. So it's a bit of a long-winded answer there, Pierre, but hopefully it's helpful. And, thanks for writing in. And I'm just conscious of time, so I might just leave it there for today until next week. Bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.